The year is 2025. The world watches as a trade war, ignited by the Trump administration's tariffs on Chinese goods, rages on. These tariffs, intended to protect American jobs and industries, have instead sparked a global economic conflict. The initial volley of tariffs targeting billions of dollars worth of Chinese imports was met with swift retaliation from Beijing. This set off a chain reaction, impacting global supply chains, unsettling markets, and leaving economists scrambling to assess the long-term consequences. The Trump administration justified the tariffs as a necessary measure to counter what it perceived as unfair trade practices by China. The administration argued that China was stealing American intellectual property, manipulating its currency, and flooding the U.S. market with cheap goods. These actions, they claimed, were harming American businesses and workers. However, critics argued that the tariffs would ultimately harm American consumers and businesses more than they would help. As the trade war escalated, it became clear that the Trump administration had underestimated the potential consequences. China, unwilling to back down, responded with tariffs of its own on American goods. This tit-for-tat exchange of tariffs has had a ripple effect across the global economy. Businesses on both sides of the Pacific have been forced to adjust to the new reality of higher costs and reduced access to key markets. The trade war has also fueled uncertainty and volatility in financial markets. The trade war has had a particularly profound impact on the relationship between the United States and Canada. While Canada was initially spared from the brunt of the tariffs, it soon became entangled in the conflict. The Trump administration's decision to impose tariffs on Canadian steel and aluminum, citing national security concerns, strained relations between the two countries. Canada retaliated with tariffs of its own on a range of American goods. One of the most significant consequences of the trade war has been a dramatic shift in energy supply dynamics. As China sought to reduce its reliance on American energy, it turned to Canada as a reliable alternative. This shift was further accelerated by the Trump administration's decision to impose tariffs on Canadian oil. In response, Canada invested heavily in expanding its energy infrastructure, particularly its pipelines and liquefied natural gas facilities. The expansion of the Trans Mountain Pipeline, a critical piece of Canadian energy infrastructure, has been instrumental in facilitating this energy shift. The pipeline, which transports crude oil from Alberta to the coast of British Columbia, now has a capacity of 890,000 barrels per day. With its expansion complete, the pipeline is now directing a significant portion of its oil exports to China. This has positioned Canada as a major player in the global energy market. In addition to oil, Canada has also emerged as a key supplier of liquefied natural gas to China. The LNG Canada project, a massive LNG export facility located in Kitimat, British Columbia, is now fully operational. The facility, which has a capacity to export 14 to 26 million tons of LNG per year, is supplying China with a significant portion of its LNG needs. This has further solidified Canada's role as a reliable energy partner to China. This energy shift has had significant geopolitical implications. China's growing reliance on Canadian energy has strengthened ties between the two countries. It has also reduced China's dependence on American energy, giving Beijing greater leverage in its dealings with Washington. This shift has not gone unnoticed in Washington, where policymakers are grappling with the implications of a more assertive China and a more independent Canada. The agricultural sector, a cornerstone of the American economy, has been particularly hard hit by the trade war. China, once a major importer of American agricultural products, has drastically reduced its purchases in retaliation for U.S. tariffs. This has had a devastating impact on American farmers, who have seen demand plummet and prices for their products collapse. Soybean farmers, in particular, have been hit hard. China was once the largest importer of American soybeans, accounting for a significant portion of U.S. soybean exports. However, Chinese tariffs have led to a sharp decline in soybean sales to China. This has left American soybean farmers with a glut of unsold soybeans, depressing prices, and forcing many farmers into financial hardship. The trade war has also had a significant impact on other agricultural sectors. China has reduced its imports of other American agricultural products such as corn, wheat, pork, and cotton. This has further exacerbated the challenges facing American farmers, who are struggling to find new markets for their products. The Trump administration has attempted to mitigate the impact of the trade war on farmers by providing billions of dollars in aid. However, Many farmers argue that these payments are insufficient to compensate for their losses. They also argue that the aid is a band-aid solution that does not address the underlying problem of lost markets. The trade war has not only impacted traditional industries like agriculture, but has also had a ripple effect on the U.S. tech sector. American tech giants, once dominant players in the Chinese market, have seen their market share erode as a result of the trade war and escalating geopolitical tensions. Chinese consumers, influenced by nationalist sentiment and wary of American tech products, have begun to favor domestic alternatives. Companies like Google, Apple, and Tesla, which had enjoyed significant success in China, have faced growing challenges. Google's search engine and Android operating system, once ubiquitous in China, have faced stiff competition from Chinese rivals like Baidu and Huawei. Apple, which had relied heavily on Chinese manufacturing and consumer demand for its iPhones, has seen its sales decline in the face of competition from Chinese smartphone makers like Huawei and Xiaomi. Tesla, which had made significant investments in China to build electric vehicles, has also faced challenges as Chinese consumers have gravitated towards domestic EV brands. The trade war has also disrupted supply chains for American tech companies, many of which rely on Chinese manufacturing. This has forced companies to explore alternative manufacturing locations, adding to their costs and complexity. The trade war has also fueled concerns about intellectual property theft, with American companies increasingly wary of sharing their technology with Chinese partners. The challenges facing American tech giants in China highlight the growing importance of the Chinese market and the risks of decoupling from the world's second-largest economy. As the trade war drags on, it remains to be seen whether American tech companies will be able to regain their lost ground, or whether they will continue to cede market share to Chinese rivals. It all started with a seemingly offhand remark by President Trump. A joke that many found amusing, but it struck a nerve in Canada. The comment quickly escalated tensions, leading to a wave of public outrage. Canadian officials responded with stern statements, emphasizing the importance of mutual respect in diplomacy. This incident highlighted the fragile nature of international relations, where even a joke can have serious repercussions. The impact of the trade war extended far beyond political statements. U.S. tourism took a significant hit as fewer international visitors chose America as their destination. Industries too were feeling the pressure. From agriculture to manufacturing, the ripple effects were undeniable. Companies faced higher costs and supply chain disruptions, forcing many to rethink their strategies. The economic landscape was shifting, and everyone was feeling the strain. In response to the escalating trade tensions, countries began to strategize. Retaliatory tariffs were imposed, targeting key U.S. exports. At the same time, nations sought to diversify their trade partners, reducing their reliance on American goods. This strategic retaliation and diversification were seen as necessary moves to protect their economies. It was a complex game of chess, with each move carefully calculated to balance short-term pain with long-term gain. As the trade war continued, the global power dynamics began to shift. Emerging markets gained prominence while traditional powerhouses had to adapt to the new reality. The future of trade was uncertain, with new alliances being formed and old ones tested. This period of turbulence forced countries to innovate and collaborate in ways they hadn't before. What emerged was a more interconnected yet competitive global economy. The lessons learned during this time would shape trade policies for years to come.